Afternoon, everyone. Welcome to the tax year end webinar with Wren Sterling, Rodliffe Accounting. We're going to run this one all the way through, but there's options for you guys to ask questions. On your right hand side, there should be a question tab in the menu, and if you write them in there, the guys will get to them at the end of the presentation, or if there's something we can't answer in the presentation, then we'll come back to it and pick up with you directly afterwards. Okay, so we'll get started, and here's Steve to talk through the first part of the presentation.
Thank you, Nick. Afternoon, everybody. 5 main topics on the agenda today. Tax year end planning for this tax year in the build up to the 5th of April. The new tax rates for 18-19 and what the implications will be for those. Phil's then going to go through the next 3 sections of the agenda, which are remuneration strategies and pensions. Then he's going to talk about some tax saving opportunities, and then at the end, business risk management in the event of sickness and premature death. Okay, so with the 5th of April on the horizon, it would be quite good to start thinking about a few things just to make sure that we've considered our income and considered the opportunities that we have ready for the 5th of April. So in no particular order, here's some tips that crop up and tips that have cropped up in the past that will be useful just to check. So obviously, a good place to start is the dividend allowance of £5,000. If you haven't taken dividends and you're able to, then utilise that allowance. Also keep in mind the £45,000 high rate tax allowance. So that's the high rate tax threshold. If, as many of you are, trying to hold your income at £45,000, then just check on that. Maybe check with your accountant at the office, just to see where you are and where you're positioned in the lead up to the end of the tax year. And then keep an eye on the 150k additional tax if you're paying yourself that level of income. If you go over, then you're into 45% tax bracket. One other thing that sometimes people forget or are unaware of is at £100,000 worth of income, you start to lose your personal allowance. This is something called abatement. So for every £2 you earn, you lose £1 of personal allowance over £100,000. Now that has an impact of, let's say you take a dividend of £1,000 above 100k, an additional dividend, then your tax on that dividend would be 450 quid, which is quite a lot, almost half of the dividend swallowed up in tax. Also, something to remember, which is often forgotten, is your income includes many other things as well. So it includes any benefits in kind that are on your P11D. It includes any interest that you've got from various places. It includes property income, pension income, and any other income that you would put on your tax return. So be mindful of that income when coming up with your £45,000 high rate tax, or indeed your 100k threshold. One thing that can crop up too is you may have to declare dividends to reduce the director's loan, for example. And if you've done that and perhaps forgotten that you did that, then that will of course be included in your income. Keep an eye on child benefit. If you're claiming child benefit, remember that when you get to the 50k income threshold, you start to lose that child benefit. And of course, when you get to 60k or over, the whole lot is added back to your tax return. So keep an eye on that, because that can often catch people out. And then of course, last but not least, you've got your capital gains tax exemption of 11,300. So if you can use that, if you're able to use that, if you need to use that, then you've got, what is it, just over 2 months? Yeah, just over 2 months. Okay, on to next tax year. A few things to mention, a few highlights. So the personal allowance goes up to 11,850. The dividend allowance goes down from 5,000 down to 2,000 next year. The high rate tax threshold is 46,350, and the additional tax rate of, the additional tax band of 150k remains as it is. I've listed the tax rates there for salary and also for dividends, but they remain unaltered going into 18-19. And of course, a reminder there, the corporation tax rate is maintained at 19%. It will go down to 18, I believe, in 2020. The impact of these allowances and tax rates will be pursued and followed up in more detail with an article or a blog that we're intending to do. But whilst we're on the subject of these new tax rates, here's a couple of very simple examples of the impact of the new tax rates and the new thresholds. So example one there, you've got a director who's paying him or herself £15,000 salary, topped up with 50k of dividends. Last year, they would have paid just over 9,000. This year, or rather next year, I should say, 18-19, getting my years muddled up, it's just under 9,000. So there's not an awful lot of difference in that example. In the second example, this example would be something that many of you on the call would try and stick to if you can, which is the high rate tax threshold. So the high rate tax threshold, as I said earlier, has gone up by 1,350. The impact of sticking to that with low salary topped up with dividends would be tax next year, 18-19 at 2,437, and in 17-18 that would be 2,137. You see the benefit there. Even though the 5,000 dividend tax allowance has gone down to 2, nonetheless the way the thresholds have moved means that the tax has gone up. Okay, enough from me. I'll hand you over to Phil from Wren Sterling.
Thanks, Steve. And ignore that picture of me. I'm here to talk to you about, I suppose, some options as a lot of contractors, company directors are kind of facing at the moment, which is trying to extract money, trying to extract some profits from the company and doing it in the most efficient manner. Just a bit about us. So we're an independent financial advisory firm, national firm, very much focused on face-to-face advice, very approachable. So if somebody's got some questions, they're very welcome to drop me an email or give me a call to talk about it in more detail later. In terms of background, I've worked with Rodliffe for about 5 years now, so very much got a detailed kind of knowledge of the common problems that are facing contractors, business owners, company directors, I suppose. And if we look at the trajectory of the kind of tax situation, it's looking less and less favourable, I suppose. Taking advice is probably one of the key things to consider. What I'm just going to go through is a couple of hot topics. So in terms of remuneration, we're probably seeing it's less favourable now to actually take money out via dividends. So if we think about, cast our minds back a couple of years ago, you pretty much got a credit up to the high rate threshold in terms of paying corporation tax. We've then seen two variations where a dividend tax, or sorry, dividend credit was introduced. But we've seen that potentially slash further to £2,000. So really, in terms of extracting money, it's becoming less advantageous to take money out in dividends, unfortunately. I'll also talk to you about a few other opportunities to maybe mitigate some of that dividend tax. And lastly is really about the risk to the business and seeing if there are any tax efficient ways of mitigating that. So we just really talked a bit about looking at salary versus dividends. One thing that is very, very attractive, and it's been a mainstream of kind of planning for a number of years now, so that by no means is this something that's a tax scheme or ways of getting you in on the revenues radar, is using pensions. And pensions really have a twofold benefit. The amount that you can pay into a pension is an allowable business for your own personal arrangements. Obviously, the alternative, you compare that to taking a salary and dividend, is in terms of salary, then maybe some national insurance expense you have to pay, but certainly there's some additional income tax there. That's in terms of profit extraction. There are some other government-backed incentives that you can take out the dividend and obviously suffer the tax, but try and achieve a further reduction or a relief, if you like, by investing it into government-backed incentives such as a VCT or EIS. Now, what these are smaller companies as the underlying investment that have certain pre-existing conditions you need to make for getting that relief. But the relief is very attractive; it's about 30%. But there are conditions that go along with that. And obviously, any time you're investing, there is risk to consider. This slide just summarises a bit more about, I suppose, how contributions are made. So you can make contributions either personally or by the employer. I would kind of suggest that, because the nature of probably what you do in your business, then the company is the more attractive route. But you do have the option to pay in or contribute to 100% of your salary. And that's capped by what we call the annual allowance, which is £40,000 per tax year. So if you were to make a personal contribution, any pound that you pay in will be uplifted by, in effect, that 20%. If you are a higher rate taxpayer in terms of income tax, and then potentially you could get a further relief of an additional 20% that you can then claim back via your tax return. What is really attractive is pretty much using the company to make the contributions. You will not then constrained, I suppose, by salary. Contributions to a pension are, as long as they meet the holding exclusive rules that fit for business, you pretty much can make an unlimited contribution to do that. I say that with the caveat that you are kind of capped at the 40,000, but you are able to go back 3 previous years and use unused allowance if you're not paid in there. So you know, in one tax year, you could potentially get £160,000 out of a company. You might not want to do that because you'd want to target, make sure you're not getting more relief than any liability to corporation tax that you will be paying. Further to that, if you think about when the money is in a pension, you get the additional benefits of that money being invested. Now, normally if you invest outside, if you don't invest in something like an ISA, then you may be subject to income or even capital gains tax on that growth or even income. Now, really attractive benefit from a pension is that that will roll up net of tax without any tax being deducted. So again, very attractive benefit for you to get a compounded return over a long time. When you actually come to draw the benefits as well, you're able to take a quarter of that tax-free. Again, so you could build quite a meaningful pot and access a lump sum from the age of 55 to help support you or achieve what your objectives are in retirement or even before that. In terms of when you come to draw the benefits, so the amount above the tax-free amount is potentially subject to tax at your marginal rate. So again, there is some tax planning opportunities if you get relief at the higher amount now, and you could be a non or a lower taxpayer in retirement. So therefore, think about the ways that you can use a pension as not just the means of extracting money from the company, but controlling future inputs of both capital income, but doing that in a tax-efficient manner. And lastly, I talked about the ability to carry forward. Again, this is a very complicated area, so if you've got any questions, I'll probably pick up with about that a bit later. Lots of clients talk to me about their risk, I suppose, to being able to earn income. When you run your own company, in comparison to probably working or being a permanent employer, you lose out on those employee benefits. So the kind of impetus is then on you to replicate potentially what you're giving up. Now, in terms of being tax efficient, there are two common options that you can look at where you can put through the business as an allowable business expense. One is to replace things like life cover or death in service, and that's something called a relevant life plan. So the company can actually take a policy out on your life in terms of life cover, but you can offset those premiums against corporation tax. If you do claim on the benefits, or your family does, then that will be outside your estate for things like inheritance tax purposes, and there's no liable to any income or capital gains tax on that because it's arranged through what we call a business trust. I'd further add to that you're able to look at something called executive income protection. So again, the most common problem for a business owner, company director, would be if they're unable to work, I suppose, through sickness or accident. So this is a means where you can insure your income, and again, the company could take out the policy on your name, offset any of the costs against corporation tax. But if you were to then claim on the benefits are then paid to the business and accessible as your normal rates of income tax as taken out through salary or dividends. I'll just give you an example of kind of the cover available, but just to summarise, it's a very cost-efficient way of really protecting your family or dependents, mortgages, whatever your need is in that case. So this is a bit of a call to action. The tax year is coming up fast. Tax is very complicated, I suppose. It's getting more and more by the amount of pages in the manual. Hopefully this just give you a brief outline of some of the strategies you can employ. Very much I'm here to help and support the clients of Rodliffe if you need to actually look at implementing some of these strategies. My contact details are there. Please feel free to get in touch. We'd welcome any of your questions.
Okay, guys, we haven't seen any questions come in during the course of the webinar, so we're going to close it now, but go back a few steps. You can see Phil's contact details. Most of you got Steve's or your regular contact at Rodliffe Accounting, so if you want to get in touch with them directly, that'd be great, and we'll also send a copy of the slides around as well. All right, thanks for attending, everyone.